welcome everyone to the 6th webinar of our Banking and Financial Services Awareness Month. The theme for our webinar or for the month is Your Money Can Be Money Smart, literally translated as Sente Yo Esobola. You are all most welcome. While we engage on the webinar, we want you to get in touch. Our Twitter handle is #YourMoneyCan. And we also want to engage you. We also want you to engage with us via our portal, which is www.yourmoneycan.or.ug. As my colleague Benedict has already introduced me, my name is Ronald Mugwanya. I work as the Training and Partnerships Executive at the Uganda Institute of Banking and Financial Services. This campaign, we are not alone. We are being sponsored, and we also have a number of strategic partners. And our strategic partners are the Bank of Uganda, FSD Uganda, and Summit Consulting. We also have platinum sponsors, Bank of Africa Uganda. We really appreciate our sponsors as well as our strategic partners. In addition, we also have multiple sponsors, starting with Finca Bank, Cairo, Equity, Pride Microfinance, Yogford, Stanbic, Opportunity Bank, and Absa Uganda, to mention just a few. Our topic for today is, balancing or striking a balance between traditional means of investment versus contemporary or the new means of or new options of investment. Now, we all know that change or evolution is taking place the world over, and we are seeing today that the financial sector is no exception to this kind of change. We've got a new generation of what is called the high net worth individuals, and these are the people who are pushing the boundaries when they are choosing investment options. In the present day scenario, we are seeing that the stock exchange, as we have always known it, is not the only means or is not the only synonym with investment. We are seeing that there is a significant drift away from the stock exchange, as we have always known it, as to be the only investment vehicle. There are other contemporary equivalents in the modern era. There are alternative investments that offer potential ways of growing money. And these ones are gaining popularity among the new generation of high net worth individuals. We can call them HNWIs. While some still believe, while many of us, actually myself included, still believe that the traditional investments are the only ways to building wealth, others are more willing to explore alternative investment paths. And that's what brings us here today in this webinar. And we want to explore these new options and try to contrast them with the traditional means of investment as we have always known them. Now, our panelist for today is none other than Mr. Paul Katongole from Bank of Africa. Mr. Katongole works as the manager, investor, and custodial services. He's going to take us through our topic for today's webinar, balancing or striking a balance between traditional forms of investment or traditional investment as we've always known it versus contemporary or new investment options. At this moment, ladies and gentlemen, please join me to welcome our chief panelist, Mr. Paul Katongole. Paul? Hello, Paul. Okay, we seem not to be...
Let me confirm whether I'm audible and...
Hello, Paul.
Yes, hello. Yes, Ronnie, I'm hearing you and I'm seeing you. Are you able to see me or hear me?
Yeah. We can hear you loud and clear. At least I can confirm to that. And I know everyone in the audience actually can as well attest to that. Paul, the floor is yours. Please take us through your experience, your expertise, and knowledge and exposure in terms of investment. how do we, as ordinary individuals, ordinary citizens, balance traditional means of traditional investment options versus contemporary or new forms of investment? Paul.
Okay, thank you so much. It is a big pleasure for me to be on this platform. Greetings to everyone, and greetings to the sponsors and all partners involved in this arrangement. My role today is very simple. It is something that all of us believe in. It is something we do. It is something we have experienced. The level at which we experience it or the level at which we execute it is certainly what differs depending on how much money we have or what our goals are and things like that. So for purposes of clarity, I will request that I will take you through my simple presentation and then possibly respond to reactions after I'm fully done with the presentation, because certainly I'm likely to preempt or answer some of the possible questions even before we complete the presentations, if you will permit me, sir. It is premised on the background.
Okay.
Thank you.
I was
just
saying it's fine. You can take us through the presentation, then we shall have reactions from the audience. Thank you, Paul.
Perfect. Thank you so much. This arrangement for everyone is premised on the fact that there are a number of factors. One of the factors is called retirement. Most of us are working, so many of you are working, others are still strong, they're running businesses and so many other things that we call them. But time comes when we are weak. Right now we might be more energetic, but time comes when we are weak. Right now we might be employed, but time comes when we don't have a job. And sometimes the perspective of losing a job or not having a job may not necessarily mean that you have to first wait for the 55 or 60 years official retirement or formal retirement in order to lose a job. It can happen anytime. I base my experience on the current situation. COVID-19 happened, and the different people probably experienced it differently. And my thought, or actually my request in this session is, as a person, just sit down and think about how did you experience the lockdown period? That period when the country was locked, economic activities were really stagnant a bit, movement was stagnant, a number of things. Employers started coming up with different measures, to make sure they remain in business, but also make sure people don't lose their jobs and the likes. And you can feel free to keep this discussion kind of coming. It is good that we get a feel of what people experienced out there, just for purposes of this discussion. And if it's possible, the panelists will sample maybe some of those for our own learning. My learning at that stage was, okay, I am an employee and I think I'm a very good employee. I thought I was very smart at what I was doing and I was confident. So 2020 comes, I have a strategy to follow, a plan to follow, both at a personal level and at the workplace. Then the next thing was, COVID, China, among others. The next thing is, okay, it's a lockdown. At the beginning, it felt like, oh, I've been so busy. I need to rest a bit. The first 14 days, let's go home and rest a bit. That's how it felt like. And I believe probably so many of us felt the same way. But it became eye-catching a little more when the lockdown was extended. When it was extended, what is that feeling that you got? One of them was, what if this goes on for the next year? How will I survive? Secondly, will my employer be in position to sustain me? So will I have a job? And this has nothing to do with whether you're a good employee or not a good employee. Thirdly, if they are to retain some people at the workplace, for example, am I classified as a critical staff? You know where you are, you probably know whether you were classified as a critical staff or not, among others, but those are things to help us think through. And fourth is to think about, what about the next life? What if I don't have a job right now? Do I go back to zero? And these are things that I think are the major basis for us to have a discussion in this. So my role is specifically going to be invoking a discussion around the things we know. It is basically that. I'll put a little more emphasis on particular things. And that's so the aspect of COVID, the aspect of retirement is key. Why I'm talking about retirement is that investment and retirement rhyme together, in a sense that if I smartly invest right now, continuously, by the time I probably retire, I'll have something that can sustain my retirement period. I will not be worried about my children's school fees. I will not be worried about how to sustain my lifestyle in a similar way that I've been sustaining it when I am employed. So those are major factors to think about. And for food for thought, it is assumed, there's actually a statistic that 5% of employees in Uganda get financially independent after retirement. And that's a very big statement. That is a very big statement. Among the employed, only 5% get that financial independency. I find that a very strong statement. Similarly, NSSF also gave some statistics and indicated that whereas the employed mostly dwell so much on, we have our NSSF package, our employers contribute, we contribute by 60, I will retire, I'll get a lump sum and I will do so much. Some of these are a bit theoretical. When people actually get this money, you'll be surprised with how fast the money gets wiped out. And the explanation to this was so simple. You see, they get a lump sum, they don't have an experience of running a business, they don't have an experience of running any alternative investments or taking major investment decision, and this is a lump sum coming at once. So because of that panic, and of course you're worrying about, I was used to a salary, I'm not going to have it anymore. I have children going to school, I still need to make sure they go to school. I need a business somewhere, so you want to start it. I also need a rental, you want to start it. Before you know it, that money is actually finished within the first 2 to 3 years. At least over 70% of those people who receive this. This is another very strong statistic. Getting into the aspect of whether traditional or contemporary, again, is a matter of discussion. Like I said, I'm just invoking a discussion. Feel free to submit your compliments, or feel free, to add on to, depending on what experience you have out there. Because here we are discussing with people who have done it. If I talk about tomatoes, there's someone among the students who has actually done tomato gardening and they have a certain experience about it. Feel free to share it, because this is the entire reason for this exact webinar. But as we discuss those different investment options, very important is that the aspect of saving and investment are quite related. Oftentimes when we get money right now, we want to invest it right now. Sometimes we are earning employees especially, I think they are earning so little, and therefore they don't have enough to invest. That is very common. Everyone believes what we are earning is not really enough. And that is very common with this big, I think, called salary. Unfortunately, what brings on that is because sometimes when I have my salary, say 1 million, I'll rent a house of, for example, 200,000 Uganda shillings. When I get my salary increased to 1.5 million, for example, then I increase my, like my lifestyle. I have to fit into that category. Then I'll go for a house of probably 300 or 400. And at the end, the ultimate goal has not been achieved. So while we are thinking about doing these investments, let's remember that we have to save on a day-to-day basis or on a continuous basis as and when we can. And from those investments, let's make sure that, from those savings, let's make sure that those savings can be turned into investments at some point. This could be short-term, this could be long-term, depending on the level of exposure or depending on your need. But the entire story of investment, in my opinion, starts with the goal in mind. What is it that you want to do? So the aspect of what is contemporary and what is traditional is again subjective for purposes of clarity, because when you go to markets like the United States, they will tell you, stock exchange is really traditional. It's something so big, it has existed for so many years, etc. And if you compare that to, for example, owning land or putting up rentals or something like that, the other hand is the alternative. But I want to put perspective to the Ugandan economy or generally for us to understand at a very personal level. So in this webinar, I'm talking to each of you at an individual basis, at least to pick 1 or 2 things from me. I'm willing to learn from you as well as we go along. So, and in this, I will not be giving direct answers as to whether you should go for this or you should go for this. It's more about, let's see what they are. And then, investing or an investment decision in itself is a process. It's not a quick yes or no, let me go for this or no, let me not go for this. That is why there are investment experts in the market that can always support certain decisions. The challenge is if you take those, if you misunderstand those decisions, or if you take a wrong decision, it can be detrimental for your retirement, for your family, for your friends, for your investment club, for so many others. So, and I want to classify and use an example of, say, let's think about land, for example. All of us want to invest in land. We all want to invest in land, whichever way. You either want to buy it and hold it, of course, for your future home and things like that. You want to buy it and develop it, and developing it in different ways, or you want to buy and sell, more like what a broker does. All these are possibilities. This is an investment, for example. But there are a number of factors that we also need to consider. Start with the purpose in mind, in my opinion. In whatever decision you're going to do, start with the purpose in mind. If I want to buy land, what kind of land am I actually buying? What is the purpose for this land? Am I going to use it for farming? Am I going to use it for, do I want to put up rental units or commercial buildings? Do I want to put a football pitch? Do I want to put a church or something like that? Now that purpose will direct you to the right location. So the aspect of location when you, for example, talk about land is very important. And the unfortunate bit is sometimes it is theoretical. We sometimes believe, you see, with land, it always appreciates. When I buy it, it appreciates. I agree with that. Land actually appreciates from time to time. But there are few scenarios where we've seen people, selling their land at a less value, a less cost, or a less amount than they bought it. In that case, would I be right to classify it as having lost value? That's one. Secondly, there is buying land today in a good location, and for purposes of this training, somebody puts up a church just against it. Depending on what target market you had, you were planning to put up rentals, but they put up a church. These churches that are where people keep praying throughout, and sometimes you wanted it for a residential kind of aspect. Will it have gained value or not? And this discussion again goes back to you. You might find scenarios where you think land is gaining value, but in reality, it actually loses value. So that's why location is very key. It has to be very, very strategic to the purpose. So you have to know where you're going to acquire it from. How importantly is it allocated to your purpose? How does it help you achieve your purpose? That is very important. Then secondly, you also have to think about its safety. How safe is that land? There are a number of processes that you can go through to confirm whether land is actually safe or not. So are you going for a private mile land kind of arrangement? Is it going to be a lease, for 49 years or 50 years or something like that, among others? So this is very important. Why I'm saying that is that there's a cost associated. There's a cost associated with acquiring it, but there's also risk associated with acquiring it. For purposes of this training, particularly, I personally fell a victim one time when I was just done with my campus. Started working, got some money, bought the first piece of land, bought another piece of land, but got a negative experience with the second piece of land. I thought in my own wisdom, I had done enough due diligence, and the due diligence involved the searches, involved asking neighbors. So the gentleman who had sold me the land had actually owned it had been with it for over 40 something years, 46 years back then. And in trying to find out from the neighborhood, from the LCs, from ETC, I thought I had done enough, enough due diligence. A year later, I received a document saying criminal trespass, and I wasn't alone. We were over 16 investors, some of whom had actually invested since 1993 or over 3 acres. So you can imagine with such a scenario, we of course had to fight our way, and we got the compensation. But as up until now, we don't know whether that court ruling was actually done between the other two parties that were fighting, because somebody had shown up that is actually his true land. The gentleman who had sold to us also thought that was his true land. And there was a long story around it. So for me, again, that was another lesson. So while we think it's very safe, sometimes it's actually not very safe. So it is very important for us to contract or to try to look for professionals who can help us in such areas, or in such areas where we need some bit of support, technical support. But there is also a cost of maintaining land. If you buy land and you don't utilize it, let me just assume some of us just want to say, let me buy it, let it gain value, I'll gain value, I'll utilize value after selling it. You don't know when you're going to sell it. So purposely, you just want to keep your money with an assumption that it's going to gain value, which is very okay. But you're going to fence it, you're going to keep running it, you're going to keep probably plowing it or digging it or something, clearing it, and things related to that. That is if you're just keeping it. But there's also a possibility that you can say, no, let me actually go ahead and keep utilizing it. Now, how you utilize it could be another, another kind of traditional investment option that you can actually take on. So in all this, it is very important that we take decisions from a knowledgeable point of view. If we are not sure, let us seek guidance from the professionals, and let us keep the risks and costs in mind. So as an employee, for example, is it safe or is it good for you to buy land or not? The answer is definitely yes, it's good. But how you go through that process is again what matters most. Sometimes we avoid the professionals to assist us, but they could probably have assisted us a lot. In my own experience, if I had, for example, gone through a professional investor, or I'd gone through back then, if I'd gone through, say, a lawyer to help me in such processes or something like that, I believe probably I wouldn't have incurred the other added costs that I incurred through when I was trying to recover, to recover my land from the criminal trespass kind of communication that I received. That is also very important. But then as we utilize it, again, another traditional kind of investment that all of us keep thinking about are rentals, or call it commercial housing. Each of us, all of us, we always want this. And the assumption behind this is that, with this, I'm assured of my future generation, my children, my grandchildren can actually benefit from it. When you're thinking about rentals or housing units, again, there are a number of factors. Keep in mind that professional services are sometimes necessary. So sometimes they come at a cost, but it's sometimes not. It's always a good idea sometimes to go through them, or at least seek their guidance if you can. So again, when you think about the rentals and the housing units, there are some dependencies. First of all, you want to construct a house, you want to construct rentals, so tenants can come and you start earning on a monthly basis. We agree with that, and it's a good idea. First, you have the land where you want to construct it. So there's a dependence on that. Meaning, if I look at the housing and rental independently, without looking at the associated cost of land onto which I'm going to construct this rental, I would be wrong. Meaning, as we develop ideas around rentals, then we start with land. But again, we also have to think about, is it going to be, what is my target market? Is it high end? Is it low end, medium class? Oftentimes, because we want to earn so much from the rentals, we want to construct houses for the high end, where you earn 1 million per month, where you earn 800,000 per month, or even more, depending on the location. That is sometimes what we tend to target. But think about the power of demand and supply. If you made a market survey, how many people actually desire to sleep in such houses? In any case, those who sleep in such houses are either about to construct their own houses, or they are doing it for a specific purpose, which could be for a short term. So if you're a long-term kind of investor, that is another perspective to think about. So again, when you compare it with these small, average, sitting room, bedroom, you realize that the demand is actually more onto the relatively lower or middle class than the high end. So while you're thinking about that discussion or that decision, again, it is very, very important to understand and to make that decision very, very clearly, considering that middle class or average class or something like that actually have the most demand. The other bit is, what about the period of vacancy? The rate of vacancy, the rate at which this space is going to be vacant in terms of occupant. A tenant moves out today and it takes you 3 other months getting a replacement. Are you making value for your money? But that is in addition to the construction costs, because you had to construct this building at some point. You had to buy the building materials, cement, you had to buy cement, bricks, among others. These are all factors you need to think about. You think about the cost of construction itself, think about the cost of maintaining it while you have tenants. There's also monitoring. Some tenants just choose to run away. There's a friend of mine who just told me he ran away from his landlord recently, and because he could not afford rent anymore, and months were accumulating. All these are possibilities. So as an investor, there's a risk you're running in such an arrangement, and that means you have to either put measures to help you curb against them, or be smart, but keep in mind that monitoring is very, very important. If you don't have the time, contract those who can help you in monitoring it. That could be another aspect. But there are also tax obligations. is, you know, the likes of rental tax, among others. You might be knowing them better than me, but there are those obligations that you also have to keep in mind. And then the return on investment. Think about a building. And like I said, these are things we know. I'm just invoking a discussion. Think about a building, for example. If someone asks you, how much can a building actually cost if I wanted to put 4 tenants, each with just a single, you know, a bedroom and a sitting room, just that? How much would it cost? You realize that all of you will come up with varied answers, and that is because of, you know, the raw materials that we're going to use, the location where you're going to put it, the nature of professional services you've contracted. Some of us just use our own knowledge. You sit down and draw up a plan, and you just come up with a construction. But at the end of it all, if you look at the return on investment in the construction sector, it is assumed that on average, it takes about 10 years to recoup what you actually invested. So the question to an investor right now, is it viable? Is it realistic? Or does it make a business sense for you to lose value for money for 10 years before you get back what you invested? That's another question that, again, that you need to answer for yourself. And there are other risks. So while I'm talking about commercial building, which also goes hand in hand with rentals, with land, I just remembered something. So many of you are in the banking sector. Fortunately, this webinar is about that. And their loans, for example. The other question is then, does it make sense for me to get a loan, maybe to buy land, or to get a loan, maybe to make a construction, and things like that? Most definitely the answer will be yes. Most definitely the answer will be yes. But there are added advantages you get with such products. For example, there are arrangements where a bank can say, okay, you want to buy land. You just present to your bank and say, I want to buy land. This is the piece of land, it's located here. This is the seller, etc. And at the end, you buy it, the bank pays the seller, they hold the land title, okay, and then release it once you've paid it. It may sound a bit tedious compared to somebody having your own money, go to the market, make the surveys, etc. But remember, a bank will not own or will not try to hold where it doesn't feel safe. No. If that land has any wrangles or it has any problems, a bank does its own background checks. And remember, they contract professional services of people to do that before they can actually offer you that loan. That is a security mechanism. So it does no harm. If I can contract it, I can get it, you know, get them to assist me. I'm trying to buy it. But at the end, once I know the bank has actually given me a loan, then I know that land is actually smart or it's actually safe. And for me, that is another safety mechanism. Pay their loan after 4 years, 5 years, depending on how much and the size and my earning. And at the end, I have my clean land title, for example. That is another perspective. But besides that, so many of us think about agriculture, farming. These are things we do. These are things so many of us say, I want to do this. I want to leave employment. I want to start. All the time we say, I want to start, but we never feel ready at any one point. This is a reality. It exists out there. Now, think about agriculture. And again, with agriculture or farming, we're thinking about, am I going to do it for long term or is it short term? If it's long term, things like coffee, things like matoke, things like trees. I'm sure some of you are already doing these things out there. So feel free to share your experience at the end of my presentation for purposes of us to benefit from experience. But there's also a possibility of saying, okay, if it's long term, say 15 years, if there are trees, how many years? And if they are 15 years, how long is it going to take me to actually benefit from them? Is the market existing? Do we have the market for them? Is it small scale? Is it large scale? At what point do I classify it to have earned me what I invested? How am I going to keep maintaining that land? So the cost benefit analysis comes in all investment decisions. Always keep that in mind, that the cost and the cost benefit has to really make sense to you in order to go for an investment options. And sometimes you actually end up going for the seasonal crops, the seasonal ones, short term. Think about cereals, maize, potatoes, a number of maize, beans, other cereals, and many others. These take 3 months, others take 4 months, others take 1 year, depending on what you want. But in all this, the cost of that investment is very important. How much is it going to cost me to come up with that? But remember the dependencies as well. So are you going to plant trees on land that you don't own? In that case, it means if you wanted to plant on your own land, then you have to start by owning land, which is also another traditional kind of aspect in terms of investment. Okay, so there are those dependencies. What about the demand? Is the demand available? Make your own research. Make sure the demand is actually available. What about the cost of maintaining it? Okay, things like diseases, there are diseases, there are pests, among others. Think about them. What about the regulatory environment? You want to plant marijuana, for example, but does regulation allow it? If it does, do you require a license for it? These are questions you need to ask yourself before you actually go into an investment, because it can become detrimental in case you did not consider such factors. What about the scale of production? Sometimes we actually don't tend to see market just because of our scale. We operate on a very small scale, and after that, no one is actually looking for that particular product. If we have large scale, then you realize the demand is actually directly attracted. There are those factors that we need to consider. But in all this, do you need your personal involvement? There are many factors, but do you need your personal involvement in all this? Maybe yes, maybe no. In case you need personal involvement, then you have to be very careful. Does that mean then you lose your job? Does that mean then you resign your job in order to monitor? Does that mean now you start assigning less time to your employer and then more time to your side, whatever you call it, something like that, among others? Think about, animals, poultry, different animals, poultry, cattle, etc. There are many factors, but the cost always stands out. The cost of operating them stands out. The dependencies, again, are you going to put up poultry on a space that you don't own? Maybe yes, there are innovations around how people can actually do this even within small spaces. Try to get that education, try to get that learn how to do this even when you're in a very small space. These are all important, and diversifying is very okay. I mean, you can own land, you can have trees, you can have a banana plantation, depending, but you have to make sure you balance your decisions and make sure you don't overwhelm your earning for purposes of making investment decisions. There are things like the market demand for this, the scale of operation, personal involvement. Again, you realize that for most of these traditional kind of arrangements, personal involvement is something that is key. You have to kind of be involved. You will either trust someone who may also not be so trustworthy. That could be another problem. And that is where so many of us in the formal sector to start a business, but you don't have people to trust to run it for you. Meaning you have to be smart at making your decisions, considering the amount of money you have, the amount of time you have available for you, among others. Now think about the merchandise. Merchandise, you want to trade, you want to do trading, you want to, to go to Chikubo, start up a business, to start up a shop. You want to deal in shoes, you want to deal in clothes, among others. What about them? What is it that you need to consider? Do you have the demand, or are you going to create the demand? Do you have a full chain of demand and supply? Do you have other dependencies? What is your scale of operation? If it's large, have you considered things like transport costs? Are you going to go to China or Dubai, among others, to import them from there? These are things that we need to think about in consideration with the raw materials. So are you setting up a mini factory somewhere where you have the raw materials and somehow you just come up with a finished good and then have it sold? Do you need, what other costs do you need? You need to pay rent, for example, in whichever building you need to pay rent, assuming it's not your own building. That's an assumption. So assuming it's not your own building, so you need to pay rent, you need these licenses, wages for the workers, transport, among others. Personal involvement, again, is key. And I think you realize that in all these discussion, on all these samples that I've already discussed, you realize personal involvement is very important. Return is very important. The duration with which you're planning this investment is very important. And the discussion, like I said, cannot be completed in a single hour that I have for this particular discussion. On the other hand, I wish to highlight that there are some other investment ventures that we consider contemporary, or that we can venture into. And I wish to spend a little more time on this for purposes of clarity. I don't want to assume that any of you knows so much about them. I know a number of you are in banking and a number of you are actually doing this. I will appreciate supplements to this discussion, but for purposes of making sure we are all at par, for purposes of this training, it's an awareness month. Let me go as basic as possible to make sure that individuals or different people are in position to fully understand this. We have contemporary investment options. For example, we have government securities. The government securities with government securities, basically call them T-bills, government securities, or government debt benefiters. What are they exactly? I think that is something I really want to cover in this particular presentation. Let's keep in mind that here, why they are called government securities is because the government is borrowing from the public. As simple as that. That's what it means. Government securities means the government is borrowing from the public. Now, there are different reasons why the government chooses to borrow from the public. For example, they have a project to run. They have projects to run. Construction of dams, construction of roads, lay rate, etc., a number of them. And this requires a lot of money, sometimes that the government treasury actually doesn't have. So it starts by coming to the public to say, look here, we are actually borrowing. We are borrowing for that. That is one. Secondly, there is also an aspect of controlling inflation or money in circulation. You and I know that when I have a lot of money with me, then I'm likely to purchase stuff a bit expensively just because I have the money. I'm holding a pen here, which I could have bought, for example, at 1,000 shillings. You tell me 2,000 shillings, I'll buy it just because I have the money in my pocket. But the day I don't have that money, I'll actually negotiate until I buy it at 1,000 Ghana shillings. So that's the power of inflation, or how prices actually tend to go high when people have a lot of money. And you know, the government does this through the central bank. It is an independent arm. The central bank, or for example, in Uganda, that is done through Bank of Uganda. So Bank of Uganda is actually responsible to control money in circulation. When there is a lot of money in circulation, then they have to get ways of getting that money, attractive ways of getting that money from the economy, from the individuals who actually hold it, and then be in position to control what exactly takes place. It is very common. We are now into the festive season, but of course this year is a bit unique given COVID conditions and all that. But maybe assuming it was a normal, for lack of a better word, assuming it was a normal year, and I'm saying minus COVID conditions, there are times like the festive season. Right now, people would be flying in from wherever they are, sending in money, preparing for Christmas, the New Year's, etc. Generally, it's a festive season. People spend. So what happens when they spend? By 1st January, we are saying we are poor. My pocket is empty, my salary is finished, etc. And this actually happens mainly because we've spent that money. Yes, you don't have the money in your pocket, but it's actually somewhere in the economy. So it needs to be swept out. So what in that case, what the central bank does is they get ways of say, let us publish government securities, let us get the public to participate. Whoever has money can actually participate, and they start earning from their investment. It's smart investments. Now, when this happens for a short time, when that borrowing is classified as short term, it's called a treasury bill. If it's classified for a long term, it's called a treasury bond. These are considered the safest world over. And there are mainly a few factors for that. Why are they considered safest? As a layman, first of all, they are released by the central bank. First of all, they are released by the central bank. And as a layman, I know the central bank is actually in charge of even printing money. So it is rare that they will fail to actually pay me, even in worst case scenario. That is one assumption. But then secondly, remember countries are rated, the credit ratings of a country. And this is because if you fail to pay your own people, you fail to pay the public, then that means it's risky lending to you. So if the country wants to borrow from international lenders, then they will borrow expensively. So in order not to borrow expensively so that you're considered safe, then it means you have to make sure you actually pay your people. In this particular case, that makes it very, 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 very safe for the investors who actually choose to invest. So when they all operate almost the same way, there are just a few differences, and I will highlight them. When it's short-term in nature, and by short-term, I'm referring to 1 month, sorry, I'm referring to 1 year and below, and that is referred to as a treasury bill or a T-bill, 1 year and below. In Uganda, they are also classified into 3. The 1 year and below are classified into 3. It can run for 3 months, it can run for 6 months, or 1 year. And the 3 months can also be called the 91-day T-bill, the 6 months a 182-day T-bill, the 1 year a 364-day T-bill. Now, with T-bills, they pay interest on maturity. So Bank of Uganda comes up to the public to say we are borrowing up to this much. It's the Bank of Uganda that comes. We are borrowing up to this much. Whoever has money, please submit. it's a bid process, or it's an auction process, also referred to as an auction process. So when you invest, for example, in 6 months, in a treasury bill of 6 months, you wait until 6 months elapse in order to earn your interest. That is basically with the treasury bills. Or if it's 1 year, you wait until 1 year elapses, in order to earn your interest. That is assuming you've not sold it along the way, but I also handle that. Secondary market. Because they are long-term in nature, they are long-term in the sense 5 years, 10 years, 10 years, any kind of earning. The answer is no. Because it's long-term in nature, they are also designed in such a way that they pay interest semi-annually. So they pay you interest every 6 months. Every 6 months, you're actually earning interest. Very interesting. So meaning you are assured that on a certain day, I'm going to earn this much. It will come directly to my account, less monitoring, less risk, and highly yielding, considering market conditions, considering our economic environment, considering the East African options, among others, for example. And that is an aspect that you can bench on. That is one. Then secondly, in all these, whether it's a treasury bill or a treasury bond, so it means if it pays me interest every 6 months, then it pays twice every year. That's what it means. So if I have gone for a treasury bond of 5 years, it means it's going to pay me interest 10 times in the next 5 years, because it pays every 6 months for the next so long that I have invested. And the beauty with this is that you can actually liquidate them. They are near cash assets. You can liquidate them at any one stage when you need. We call it the secondary market. At any one point when you want to sell them, it is possible to actually sell them. That means even when you commit to a long term and then at some point you realize you need urgent money or quick money, you can sell off what you have earned, what you have invested, or part of what you have invested, and earn from it. But in addition to that, you have already earned the interest of it. For example, a current 15-year bond is running at 17% in the current market conditions, amidst the current market conditions at 17% per annum. You earn 17% per year. That is something smart. That is something clean. You're not going to be worried about it. So the aspect of liquidity is very possible. Secondly, there is also an aspect of you can use them as collateral. You can use them as collateral. You want to borrow against them. These are recognized because they are easy to actually validate. In all these, for every interest that you earn, we commonly call it coupon. For every coupon, or let's call it, for purpose of this discussion, let's call it interest. For every interest you earn, there is a withholding tax perspective. So on your earning, not on your principal amount or not on the initial investment amount that you invested. If I'm earning 10 million, for example, from my investment, so that 10 million, that gross interest is what is going to suffer a bit of withholding tax for purposes of tax compliance. In Uganda, they classified into two. The investments that are 10 years and below will suffer a withholding tax of 20% effective last year. And those that are above, that are 10 years and above, have a tax incentive of actually 10%. So again, that is to highlight whether you should go long-term or short-term and their benefits for going a long-term, because it means then the central bank will actually be having your money, but you're earning from your money. Now on all these, for the treasury bonds, on maturity, assuming it was 5 years, so I'll earn my interest every 6 months for the next 5 years. Okay. Now, in the fifth year, at the last installment of that interest, then I earn back the initial amount. But remember, as you earn every 6 months, you can keep reinvesting this, meaning you can actually keep accumulating wealth through this kind of arrangement. There are a number of many things that I could highlight in this particular area, but for purposes of this discussion, specifically for everyone, allow me share a screen, moderator. Allow me share a screen. Allow me share my screen and highlight. Let me know once you are in position to see it for purposes of clarity. Ronnie, help me confirm whether you're in position to see my screen.
Yes, Paul, the screen is shared. We see it very clearly.
Very clearly. Okay, thank you.
Yes.
Because of making this a little practical, and you'll highlight in case I'm in case I'm taking more time than I'm supposed to actually take, but I felt it was nice to look at some numbers here.
No, it's okay, Paul. You could take us through the presentation quickly, so we can also get into the Q&A, because I know participants could be having some concerns and they want to raise them. Already they are sending in questions, so it's okay. Let's go through this, then we could get the Q&A.
Okay, very fast, for example, thank you too. Very fast, for example, this is a 5-year bond that is currently running on the market. It's paying at 16.625%. And that means depending on how much money you have invested. If you looked at the first investor, for those of you who are looking at the screen, who has 10 million, for example, and there's also an assumption that this 10 million is saved. Probably you kept on saving until you gathered it, and it could be any figure. So we can keep changing these figures to get an idea. So you see that, for example, this person actually earns a gross interest of 1.6%, sorry, 1.6 million, and then suffers a withholding tax of 20% to get them to a net annual interest of 1.3. But you're earning 1.3 of a 10 million. That is something good. You're investing 10 million, but at least you're earning a clean net 1.3. The figures keep increasing, as you see in the projection, so you can try to fit yourself where you actually belong. I see someone over 300 million who will be in position to earn. What you see in green is exactly what you earn, the actual money that will come to your account at the end of the year. But I've also highlighted what it looks like semi-annually. So for example, a person of 300 will actually earn a net interest of 39 million per year for the next 5 years. And that means every 6 months, he will be assured of 19.9 million. And if I prorate it to a monthly basis, at least this person is assured of, a 3.3 million shillings. I'll give you another example of 100 million. And maybe this could be easily comparable with the likes of rentals, among others, that so many of us actually relate with. If I use 100 million, for example, I'll earn 13.3 million, for example. This correlates with shillings on a monthly basis, clean, no possibility of, failing to pay me, among others. And the other question is, okay, what if you use the 100 million maybe to put up rentals? For you who are really practical out there, how many rentals can actually this put up, and how much money can you actually earn from these? What about the cost of monitoring? What about those tenants that keep running, among others? And then I've given another example here, which is a 15-year bond. With this, it does not mean that because it's 15 years, then I should hold it for 15 years. There's what we call a secondary market, where I can actually buy it. It's 15 years because it's paying at 17%. But my target is actually to earn 17% for the first 3 years. After 3 years, I know it's going to pay me every 6 months at 17%, as if I'm going to hold it for 15 years. Then after 3 years, I actually sell it off in what we call a secondary market, among others. So again, using a similar example and a different rate, you can see the difference in figures. You can see there's a tax advantage on the long-term ones, 10% for the 15-year, while we looked at 20% for the 5-year and the like. And this discussion can actually keep going on and on and on, among others. But we also have scenarios where we can explore, the equities market. The equities market, basically, we are looking at, we are trying to own companies. That is basically what it means. You are trying to own a company, you're buying ownership in a company. Buying ownership in a company means that company was established at some point. Usually it starts with individuals or a family. It can start as an investment club, then becomes a company. Then they get so ambitious, they want to expand into different markets. At some point, they don't have enough money, so they want to get money from the public in a process that is called an IPO, an initial, where they actually come for the first time. The public say, let's get the public to buy shares into our company. So there are different ways of earning from this. You can buy these, and these are done at stock exchanges, but of course there are also those alternative ones that are not really done, that are not really listed But for purposes of discussion, I'll look at those that the stock exchange. You've heard about Uganda Securities Exchange or Uganda Stock Exchange. You've heard about Nairobi Stock Exchange, Johannesburg, among others. So there are different ways of earning from these. You can either buy when the shares are low, or the price for a share is low, and sell when it's actually high. You make a profit from that. That is one. Secondly, you can buy and hold with an assumption that you will earn a dividend once, which is declared annually. It is not a must that dividends will be declared, and there are prospectuses that guide this kind of arrangement. So depending on how the company performs, times they will actually, there are times they will publish how they are going to pay dividend, how much they are going to pay, or sometimes they may actually not really fully pay, among others. So with this, you're basically buying ownership in that company. But the question is, how stable in terms of prices are these? Am I sure that once I buy them, I'm actually going to earn from them? That answer is subjective. That question is subjective. Its answer is subjective. Why? Because their prices are so volatile to the extent that they change every single day. Every single day, those prices change. And whether you're a short-term investor or long-term investor, Umeme, for example, came to the market in 2012, if I remember well. Its share price, a single share price, was at 270 Uganda shillings. And this kept on growing over the years, and investors kept on earning over the years. It reached a peak of 690. So you can imagine if you have your 1 million Umeme shares and it's trading at 690, it means you're actually earning so well. In addition to that, it has been consistent with paying dividends, among others. And then at some point, a discussion comes into whether the Umeme concession is going to be renewed or not. Again, that is subject to debate because that has not yet been renewed. But investor sentiments, again, sometimes investors want to feel so secure. If they are not sure if it's going to be renewed or not, then some of them could either pull down, etc., or demand really gets affected. And as I speak, it's in 240s. So the question is, there's a person who valued their assets in Umeme shares when each share was at 690. That person, their asset was high up there, depending on the number of shares they held. And then that same person, if that same person tried to value their assets right now, where each share is at 240 or somewhere around 245, again, there's a question of discussion. So you'll see that shares, among others, are more to the long-term investors. But in all these discussions, for purposes of time, all these discussions, it's very, very important for us. I would not encourage anyone to just simply go 100%. Encourage you to sit down, think about an investment plan, think about, come up with your portfolio. It can start now with the little that you have, and then you just keep on growing it. By the time you retire, you probably I'll have a farm, I'll have some rentals, I'll have some equities, I'll have some government securities, among others. But being in banking, you also know banks also offer some investment other investment options like bank deposits. Of course, these are fixed deposits, term deposits, and then call deposits. With a fixed deposit, you're simply contracting with a bank to say, at this rate, you agree with the bank, at this rate, I am fixing my money with you. In other words, I'm lending you my money, but you're going to pay me at this particular rate per annum for a period I have actually invested. Now, with a fixed deposit, you only earn on maturity. If it was a fixed deposit of 90 days, it's only after you've held it with a bank for 90 days that you'll get your earning. Should you want to terminate this investment before that, you will have breached the contract that you have with the bank, and in that case, they'll give you back what you invested, but they will not give you the interest. But there's also what we call a call deposit. You can call on it whenever you need. So with it, the bank doesn't know for how long they are going to hold that money, and that is clear right from the word go, and then they'll give you a rate at which you're earning. So at any one point you want to terminate this kind of arrangement, very interestingly is that you can at least be sure you will earn something from it. We hear about oil and gas, among others, being options in Uganda, and the discussion around this is actually difficult to conclude at the moment. But as an individual, where do you see yourself in terms of opportunity? There are questions that keep coming in. Do I go for a certification? Should I go for a certification? Should I go for a master's in oil and gas so that I position myself? I mean, investing in education is never a problem at any one point. It's always an investment is an investment. But again, try to apply the current market circumstances try to apply your knowledge to the production cycle. Where are you going to fit in the production cycle? Where I'm seated, I believe in Uganda, the main opportunities that actually lie with oil and gas, especially with SMEs, let investors come together to be part of the supply chain. As simple as that. There's a whole lot that has been planned. Those people will, for example, need breakfast at a certain day. The workers will need breakfast, will maybe need chicken or for lunch for a certain day. But if they contracted you to supply that chicken, you will be overwhelmed if you're a single investor who has his poultry, his poultry farm somewhere. What if investors came together and say, for us, together, we shall be in position to provide value to this by providing poultry, by providing eggs, etc. I think there is an opportunity. So now for me, key pointers is that while we are investing, let us try to limit as much in terms of risk. Let us try to limit ourselves from overexposure, but then also exploring a few opportunities out there that are a bit risky. It may not be a bad idea, assuming they take a small percentage of your portfolio. You can start small and then keep gradually growing this. This will give you a bit of experience. If I've never bought a treasury bill, I can start by buying it, at 100,000 being the minimum, for example, and then I keep growing it. Then I get an experience with it that at any one time when I get my NSSF, probably I know I can try that out. It is key to diversify your portfolio. Keep in mind that, it's not good to put all your baskets in all your eggs in one basket. So that is very, very important. In areas where you feel there is need for professional advice, feel free to come to the professional individuals or investors out there. I know this discussion can go on and on, but I would also like to hear experience from people out there who are doing it. Because of the time limit and because of the current market conditions, I'm not in position to go to every alternative, every investment. There are really, really so many. Some of them are regulated, others are not regulated. And because it's not just a classroom, it's not a classroom lecture, it's just for us to share ideas, especially how do we get ourselves from the current period? What if we don't find a vaccine what if a vaccine for COVID is not found? What then happens? There are people who have investment clubs that because they wanted to survive, they ended up eating or sharing or whatever, utilizing whatever amount they had for their investment club. Now it's back to zero, for example. What if this condition does not end? So it means we should premise it on the fact that whether with market risks or not, I am safe, I am assured of my retirement. And to give another example is, for example, we all want to construct houses for rent, and that is respected on my side. But I also want to challenge you a bit. For example, imagine you're going to construct a house of, let me say, 100 million. Okay, let me even just say 50 million, assuming it's a low-end kind of arrangement, 50 million. And imagine from your savings, you can only manage to save on an annual basis about 10 million Uganda shillings per year. So it means it will take you 5 years to complete those houses. And assuming they are rentals, tenants always want it when it's finished most of the time, a little more realistically. So it means in the 50th year is actually when you're assured that you'll be in position to start earning from the rentals. And then it takes you about 10 years to recoup what you actually invested on average. So what most of us do is, one, we will, because I know I have my 10 million for this year, I want to start, and we all do it. I want to start because I'm going to utilize this money. I'm going to divert this money. So you want to start. So you start immediately. You start, putting up bricks, raw materials, among others. You construct the 10 million, actually stop somewhere near the foundation, and now you have to look for the other 10 million. Okay, on and on. So the next 10 million take you up to maybe the wall plate or whatever it is, and then you go on. So in the 50th year, you've completed your house and you're actually happy. But from a time value perspective, as investors, we're thinking, in that case, have you actually gained value for your money? The time value of money, we know this is a reality. You had the first 10 million, you bought concrete, put it in the ground for a house that is going to be completed in the next 5 years. Are you making the right decision? That I'm leaving that to you. Are you making the right decision? What about somebody who first got that 10 million, bought a treasury bond of even 5 years, starts earning 16.625%, for example, every year using those 10 million. The next year he adds on, but in the 50th year, it is actually maturing, he has gained from it. Similarly, you have children going to school. You pay school fees for the next month, sorry, for the next semester or for the next term today, yet the term is going to run for 3 months ahead, or 4 months for a semester, for example. What if you bought a 3-month treasury bill, for example? Then on its maturity, you actually pay the school fees. Its interest helps you in buying scholastic material for these children. And these are examples, they are varied examples. Allow me stop here in terms of my presentation and be in position to, to respond to some of the concerns or requests, but happy to receive further guidance from those who have experience out there. We really, really appreciate, and we think we can appreciate more for those who have done it out there to share a bit of experience. And the topic of investments is usually subjective. People will always, most of the time, try to defend the decisions they have taken. Whether it's a wrong decision, sometimes they want to defend it to ascertain that what they decided was actually right. But at the end, we want economic recovery. We want everyone happy. We want us happy for our retirement. We want our families happy. Thank you so much. Ronnie, over to you.
Thank you so much, Paul, for such a wonderful introduction and adventure into the world of investments. It's really very impressive. You are such knowledgeable and such an expert in this area, yet you inspire us to engage within the discussion, and you don't appear like you don't want to put it like you have exhausted everything. So it's at that point that I want to ask the audience to come in with suggestions, or if any kind of advice, or even to share experience with us. I see someone on call who probably appears to be someone with quite some experience. Alex, the other name is not indicated. You could probably write in to say a thing or two regarding what Paul just said regarding traditional investments and contemporary investments. Now, while Alex comes in, or any other person on call comes in, I want to suggest that we undertake a poll. We just want to get the kind of investment know-how within the audience. There is a poll which is going to appear on our screens in about 30 seconds. Yeah, it's already on the screens. Please kindly respond to the few very simple questions that we put on the screen and press submit within just even less than a second.
So what about those who have more than one? I see, for example, rentals and land, and it's a radio button. So
you
somebody
could,
can only submit one.
Tick as many as you feel applicable. If none applies to you, you could just leave it.
Okay.
Please, when you are done with the poll, you could just press submit, and we'll go through the results. Press submit if you're done. Okay, like we said, if there are no people coming in with suggestions, coming in with any experience with investments, let's just briefly take on the poll, and in about 1 or 3 minutes, I'll be reading out the results. In the meantime, let me also take the opportunity to inform you about our book. It's called Straightforward Financial Growth, and this book was authored by Moses Mukisa. It's a very good book about financial literacy. It takes in Bible principles. For many of you who are Christians, it's a very, very, very insightful book in the field of financial literacy. For you to win a book, like right now, I've got 5 copies that I want to give out for free. Paul, you don't have to worry because yours just comes automatically. You are the panelist. I'll be giving out free copies, about 5 of them. But in order for you to qualify for this book, at least engage with us on our Twitter handle. I already read out the Twitter handle. It has hashtag YourMoneyCan. Alternatively, you could also come through to our web portal, which is www.yourmoneycan.or.ug. You could give us a preview of what you think you have benefited from this particular webinar, or if you have been engaging us with the other webinars that have come before, just come through, tell us, share with us your photo, and you'll be appearing on our photo as someone who has contributed a review, or someone who has informed us about the lessons, the key takings that you have taken away from the poll, from the webinars. Can I have the results of the poll, please? Okay, while the results of the poll come online, Apologies for the short break, ladies and gentlemen. We are going to restructure our poll a little bit because I've just been informed that we need to embrace the concept of contemporary investment options as well, because when you look at our poll, it has been biased towards the traditional options. Probably that's what we are mostly informed about. But for now, we're also going to include a few questions about the contemporary or the new investment options. Okay, now I will also now come in with a couple of questions. The participants or our participants have been sending in quite a number of questions, and it's to this that I want to turn to. Before we go into the questions, there are also reviews that people have sent in, and Mili Mbuliro says that very good discussion. Thank you very much. Okay, very good discussion. Thank you very much. I think that is a thank you to Paul. It's a vote of thanks. Let Paul talk to us more about insurance units, about insurance unit trusts like UAP, umbrella unity trusts. Now, Paul, you don't have to put that down. I'll request Mili Mbuliro to tune in to our next week webinars, because we are going to be discussing the pillar of insurance as one of those that is fundamental to the topic of financial literacy. So we are going to skip that for now, but the key takeaway here is that Mili Mbuliro is actually appreciative of the kind of discussion that we are having right here. Another view came in from still Alex: explore opportunities in agriculture as a viable investment opportunity. COVID-19 has shown us that agriculture is an essential sector. Let us not relegate it to the less educated. Alex Mutwa, Nile Microfinance in Arua. Alex, thank you so much for the comment. It has been taken. Now, Alex, Paul, I want to come in here briefly. You have talked about NSSF and how over 5% of people who retire do not actually get that kind of financial independence at retirement. I'm coming in with this first because it is something that has been echoed by panelist after panelist. However, I want to believe, or I want to seek clarification about this. People are going into retirement, they've got a bit of money. It's not like they don't have anything at all. Probably they have saved. NSSF is mandatory saving, but a couple of years down the road, everything has vanished. Should we consider this a case of poor management and business leadership rather than a case of poor investment skills or lack of financial literacy? Just in about a minute or two, let's just try to explore that before we get to these questions that are really biting from the audience. Over to you, Paul.
Well, thank you so much. I think I would classify it under financial literacy, because if I'm 20 years and I'm working until 60 years and I start discussions like this, learning like this, I get to know the options where I can put money. There are quite a number of them. By the time I retire, even when you give me a lump sum, somehow I'll know how to manage it. Now, the problem happens is that when you get that lump sum, you've not explored any of those options. So you start working on assumptions. You start imagining, going to Dubai to starting a business where you're importing from Dubai or China will be the main way to, for your survival. You start panicking. You are used to a salary, you don't have it anymore. You start thinking about your school fees, among others, like I've mentioned earlier. So you oversplit this money in a way of diversifying, but not in a smart investment decision, not by taking smart investment decisions. And for me, it's a question of literacy. So if we can, let us train people. If we can, let us talk to our relatives, let us talk to uncles, parents, etc., who are about to retire, so that they don't fall victims of such. Secondly, there are people out there who, target those people who are about to get that money. They will come and excite you with so many scams out there. They will excite you with them. And if you're not careful, you can actually lose what you invested. But if you're financially literate, you're likely to take cautious decisions on this. Thank you.
Thank you, Paul. We've all heard it, including people in the audience. Just be cautious. There are scams out there. Financial literacy helps you in identifying the best investment options and also putting your money where your mouth is. I don't need to add anything to that. Paul, there are quite a number of questions, but I want to come in with a batch of 3 at every step. Is that okay?
That is very okay.
All right. Now, our first question will be, people always choose to invest, like we're talking about investment. So there's a choice. In choosing an investment, what actually matters? When someone, for example, I am making an investment choice, what actually matters in that choice of investment vehicle, and how much should that actually matter? That's number one. We also talked about, for number two, we talked about shares, investment in shares, investment in bonds. But we know that many companies somehow withhold information. They do not publicize all the information that there is for the public or potential investors to know about. They withhold that kind of information regarding, for example, their financial welfare or even legal suits that they may be facing that could probably turn out to be so costly. Now, how do I do my due diligence in researching a company before investing my money in that company, bearing in mind that there is information that could probably never be found on any public forum? You've heard about the cases of Enron, the cases of Toshiba, and so many others within the business, international business literature. So we know about that. How do we defend ourselves against withholding of information? Then lastly, out of the batch of three, what part of my investment constitutes a risk premium? If there is risk, what is the actual meaning of risk from an investment perspective? Those are the first three. I think Paul, let's respond to that, then we'll get back to the rest of the questions. Thank you, Paul.
Okay, thank you so much to the audience who have raised these questions. I'll start with a question on what matters when you're making an investment decision. Like I said, this discussion is quite broad. The number of considerations that you have to make, but very important is, remember, you're making a decision for yourself. That's the first thing. First of all, do you have the money? So it all starts from how much have you saved or how are you earning? That is one. So are you able to you'll be in position to afford this kind of investment. Sometimes they're nice out there, but we can't afford them. So there's an aspect of that. Secondly, what about the risks? Are you willing to actually lose or for a possibility of losing what you invested? That's another aspect. Some of those that are highly risky are actually highly earning and tend to be so attractive in terms of they can easily attract you or entice you to actually put your money. But are you willing? What would be the worst case scenario if you lost what you have invested? That's another perspective. So the return on investment is very important. How long does it take you to get back what you invested vis-a-vis the risk of or possibility of actually losing what you have invested? The case of government securities, for example, where a risk is actually almost minimal, apart from the sovereign risk that we know about, almost not existing. Again, there's power in knowing that I will not lose. For starters, I will not lose what I have. That's a starting point. And then how much to get out of that will now be determined by which options you're going for or which tenors are you actually going for. The time, that same question talked about something on time. When was it about when will it be, when is the right time to, if you can remind me, when is the right time to invest? But there was something on time or the timing of that investment. So if it's about the timing of the investment, the market conditions really change. And this is now where professionals come in. Market conditions change. GDP, for example, last year was at 6.8%. Right now, it's at 2 to 3%. That means the market is greatly affected. The central bank lending rate was lowered to the lowest, record lowest, 7%. The understanding with this is that the central bank rate, or CBR, is the rate at which the central bank lends money to commercial banks. So because it's deliberate about private sector growth and rejuvenation of the economy, they lower it so that banks find it cheap to borrow money from the central bank. But in return, banks also lower their lending rates to the public, so the public is able to actually to get access to this money. But again, another question is, do you think banks are really willing to expose themselves so much? That's another discussion. Because yes, you're encouraging me to lend out, but is it safe? How many people are actually defaulting out there? So there are those many factors. Inflation, think about the currency. You know, our currency has been stable. And sometimes some of these are actually theoretical. Some people will tell you, you know, holding money in US, you know, in dollars, US dollars against Uganda shillings is actually better. But we've seen times when a Uganda shilling actually appreciates against a dollar. That's again subject to discussion. There are a number of factors. So we look at inflation. Currently, we are seeing inflationary figures going up purposely, especially because of the prices, especially driven by the prices in the transport sector. After the announcement of the easing of the lockdown, we see public transport operating at half capacity, but the operators also have to want to make sure they don't make a loss. So you see the prices or the fares increases, they increased, and then again, that in itself tends to increase the inflation figures. So that question is quite broad. It's a number of factors that you really look at. But that same question also talked about how much can one invest. It's entirely about you. But if you were specific with government securities, like I saw in a chat, somebody talked about government securities. What is the minimum that someone can invest? You can invest a minimum of 100,000 Uganda shillings, and 100,000 Uganda shillings for government securities, for example. For the rest, it's really subjective. If I'm talking about land and you're asking me how much should I invest in land, I'll also ask you which kind of land you want, where is it located, how much are they selling it, what is the market value for that area. And you see that even at 500,000, you can get a piece of land, whereas you can also get another piece of land at 500 million. So it is really subjective and entirely depends on the investor. Now, the second one about shares and the limited information. It is true that information is limited out there. So not so many of us get easy access to this information. We encourage so much the use of investing in companies that are listed. It is possible to invest in others, but those are the challenges you face. If you invest in companies that are listed, there's a whole regulatory requirement where they have to publish their information. There's a settlement market. In this case, the exchange in Uganda, for example, Uganda Securities Exchange or Stock Exchange. There's capital markets involved. So this information can be got from official websites for official announcements and in newspapers. For example, all listed companies in Uganda publish their financials as an example in the newspapers, on the media, on their website, and it's a regulatory requirement. So this is a good area. This is a good area where we can easily get information. The moment we tend to go informal, that is where now we face the challenge. The last question was about the risk premium. What would constitute a risk premium in your portfolio? Well, again, subjective, but I think if you expose your portfolio to 20% overall, that is okay. If you can play safe for about 80% or close to 80%, and actually the regulators mostly encourage around that, and then for the remaining 20%, you can now expose to those that are risky, etc., to the extent that if you lost, worst case scenario, you can only lose up to 20% of your portfolio. There you're working for your retirement. Should you do the opposite? I mean, the moment you fail to make a right decision, then you can keep cursing the decision that you take. Thank you so much. Back to you, sir.
Thank you, Paul, very much for shedding light on the different concerns raised by the audience. Now, before I bring in another question, Simon Odeke asked about the minimum amount they would require for that is necessary for them to buy government bonds, and you've actually answered that already. However, in the process of you answering that question, something else came into my mind. Okay, I've got my money, the 100,000, which is the minimum, very little money probably for most people. And I now want to buy these bonds. I want to buy the treasury bills. And coming from the experience of, say, having this campaign for the sake of financial inclusion, many people, or majority of us on call could probably know how to go about the process of buying these bonds. Now, from the point of view of someone who is working on a construction site, for example, who is working on, who is a border rider or who is a market vendor somewhere, they want to invest in this kind of venture. How do they go about the whole process? Like, is there a small shop somewhere in Chikubo, in Mkwanakedi, or somewhere along the streets where you could just walk in and pay for these products? How do I go about this? Please just take us through the actual process of, me wanting to buy and actually paying for this and it becoming my product? And how do I own it? How do I prove ownership of this product? Over to you, Paul.
Thank you so much. It is interesting. You said probably everyone knows about this process on this call. You'll be surprised that we work in banks, but not so many of us actually know about these products and how they work. So which is very important to have people on this on such a call. But I like the example you've given about, you know, somebody on a construction site, a border guy who wants to invest in this. How do they go about it? It is interestingly, the process is very, very, very simple. Whereas these are published by Bank of Uganda, and so many of you probably see these in the newspapers, but with less interest, of course, you just skim through those newspapers. But as you pick interest, you start looking at them, trying to be keen about them. The process is, as much as they are published by Bank of Uganda and therefore you invest with Bank of Uganda, you don't actually go to Bank of Uganda to buy them. Bank of Uganda has appointed all banks in the market to participate, to support clients. And the main reason for this is that the banks do due diligence on their customers, know your customer. So the bank can actually attest that this customer's money is actually clean. Among others, we know this customer. So they go through the different banks to buy the different bonds. And in that case, the requirement is so simple. One, you need a bank account in a bank that can do this. You need a bank account because you need an account where money will go, an account where that will facilitate movement of money. When you're buying, just like when you're buying, a pen or from somewhere, you incur a cost. So money leaves your pocket. In this case, when you're at the point of investing, money will have to leave your account. So we start with the account. So any bank that, any commercial bank in Uganda, for example, you can do this very, very well. Then the commercial bank will have its requirements of opening an account, a normal account, normally an ID and just your photo or something like that. Now, after having that account, you fill a form. It's called a CSD. CSD stands for Central Securities Depository Account Opening Form. So CSD is Central Securities Depository. It's a CSD form. It's a Bank of Uganda form, just a 2-page form, very simple. It's just asking for your basic information, your name, date of birth, mother's name, things like that. What is your account name? What's your account name? What's your account number? In which bank you have your account number? And by the account number, I'm referring to the account in your bank, that normal account, that normal savings account or current account that can also do other things. That's the account they're asking for. So you fill that information and you submit that information to your bank. Now, your bank, of course, validates that you filled the form very well and then submit the same to Bank of Uganda. But in addition to that, because it's an automated environment, Bank of Uganda has provided front-end access to their system that opens the accounts. So your bank will actually open this account, that CSD account, and at the end, that account is fully opened. Commonly within we can say maximum only 24 hours, but it really depends on how the bank directly operates. Now, once they have opened that CSD account, but remember that CSD account will be presented, it's at Bank of Uganda, but it's ideally linked to your cash account. So that's to facilitate the investments. Now, once you have that done, that means you're ready to do the investments. So your bank will now communicate to you that this is the CSD account that has been opened for you at Bank of Uganda. In addition, remember you have a bank account with that bank, and it's as simple as that. Now that's at the point of opening the account. But you also talked about then how do I invest, or how do I get to validate and confirm that I actually hold that investment? Now, the account opening process has been done. The account has been communicated to you. You know I have a CSD account. Maintaining this CSD account is of course free of charge out there, regardless. So you can open it even today when your intention for investing is like next year or the other year. It is okay. The account will still be there. So once that is done, the next thing is, now I want to invest. Assuming you've studied the market conditions, these bonds and bills keep coming to the market from time to time, rates keep changing. It's about taking the decision and say, okay, now I want to go for, let me say, a 2-year bond as an example. So you will fill another form. It's a Bank of Uganda form, that form, there are 2 possibilities when you want to buy. There's what we call a primary market and what we call a secondary market. The primary market is when Bank of Uganda comes to the public to borrow, and then those who have money submit. By submitting, it means you're buying that treasury bill from the primary market. Now, the secondary market, on the other hand, is now those who bought from the primary market wanting to sell to others out there. They could be individuals, companies, among others. Now, when that happens, So again, this informs your decision whether you're going primary market or secondary market. But assuming you're going primary market, again, you just submit that form. It's called a bid form. It's a one-page form, just asking which investment you want to go for. I want to go for a T-bill of 364 days.
Okay, while we still wait to get back to Alex, our poll is now coming on your screens. Please just tick up the boxes and submit. You could see, you can now see the poll on our screens. Please go ahead and do what's necessary. You could tick all the boxes which apply to you, not a problem. There are only 3 questions. When you are done, please just press submit and we can move on. Have we all done the submission of the poll? Okay, while we wait for Paul to get back online, probably he's had a disruption with the internet. I was talking about the book, Straightforward Financial Growth, authored by Moses Mukisa. Please, there are 5 copies that are going to be that are up for grabs. If you're interested in getting a copy, just engage with us on our Twitter handle, which is #YouMoneyCan, or you could go to our web portal and send in a review of the webinar. It could be this webinar or any that you've attended before. Our portal is at www.yourmoneycan.or.ug. Please send in a review and tell us what you think about the whole financial literacy, the Financial Awareness Services Month, and let's get to know, share your experience with everyone out there. For those of you who cannot get to Twitter and you cannot get to our web portal, use the same email that you received the invitation on, and use the email that you used, the email where you received the invitation on, and send me a message regarding your experience on our webinar. Please let us know. Send also a photo of a copy of your picture. We'll upload those on our web portal. Okay, the results for our poll are in. There are still quite a number of people who haven't yet submitted. Let's just wait for those to come in. Now, Paul has been online and he's been talking quite a lot. At this time, I want to hear from what everyone else has said. Probably before people come in to say anything, let me also read through what the different reactions are from the audience. I already read out Jemima Semakade's view, and Jemima, you've been with us for most of the webinars that we've been conducting. I want to assure you, Jemima, you have won yourself a copy of Moses Mukisa's book, Straightforward Financial Growth. You could just send me a review of, I think you don't even need to send in reviews because you've already been doing a great bit of work here. Namirembe Juliana, Mr. Katongole, okay, that was about the network, but that has been sorted right now. Katongole is back online. Brian Rutembera, okay, what are your thoughts of side hustling alongside your primary job, most specifically in agribusiness? Probably, Brian, you are talking about agribusiness as still a form of alternative investment other than from the stock exchange as we have always known it. Probably, Paul, it's good to see you back again on call, and you'll probably respond to Brian's concern. Doris Mitty, so if I have my 10 million to invest and I'm contemplating either unit trusts or treasury bills, which one would you advise me to go for? Which one would give me higher returns on investment? That is the second one. And remember, Paul, we said we'll be having a batch of 3 questions. Let me look out for what someone else is saying here. Benedict says, kindly share Paul Katongole's contacts. We need to engage him on a one-on-one if possible. That will now depend on whether Paul wants to have his contacts published to the audience. Miri Muliro, I already read that out. There is Alex. Alex here came up with something. How can commercial banks demystify TBs, treasury bills, as an elitist investment vehicle? Probably the whole issue of investment using commercial banks and other professionals is seen as an elitist thing. And Alex has indicated that he is coming from a microfinance institution. So probably these people are also interested, or the microfinance sector is interested in getting their clientele to get to invest. How do they do, how do we demystify the element of investment from elitist to something that everyone can consume? Again, going back to the area of financial inclusion. Thank you, Paul.
Well, thank you so much, Ronnie and the team. Sorry, my apologies for the disconnection. I got disconnected. I got a technical challenge here. I'm glad that I'm back. I had not yet completed the process of investing in a treasury bill. I don't know whether I need to first go with complete that and then proceed to these questions, or but it was, what was left was really so small. So Ronnie, you can advise.
The network broke down a little bit. Paul, please, if you can, I beg your pardon. Paul, are you getting me? Hello, Paul. Okay, while we still wait for Paul again to regain the network, let me look around here for more suggestions or more reactions from the audience. What are people saying? Stephen Ephraim, Stephen, you've also been around with us through all the webinars that we've been having. Stephen, you win yourself a copy of this book. Write to me through the mail that you received the invitation from, and just tell me how the book would come over to you. Can we have the book on the portal? Unfortunately, Stephen, the book is in hard copy. We cannot have it on the portal. However, we could also explore options from the author, Moses Mukisa, and see how this can be done. Please share Twitter handle again, Angela Namugaya. Angela, our Twitter handle is at #YourMoneyCan. That's our Twitter handle. You can also see the Twitter handle down below on the email which you used to register for today's webinar. Caroline Gua today, kindly share Paul Katongoli's contacts. I've already noted that. Paul will inform us whether he's happy having his contacts shared. Ask if he is okay giving out his contact. Okay, that is Ben saying. Now, Barbara Namtesa, we are not able to pick more than one option for any given reason. Probably you, Barbara, you are reacting to the question of whether you could pick more options on the poll, but it's okay, you can pick more than one poll. And I want to inform you that we are going to run another one, and another poll. We are sorry that many polls coming over, but we just keep refining them just to make sure that you get the best out of the webinar. There's going to be another poll which is going to run, and this poll is going to give you options, as many as you wish to complete. Someone here, okay, the name is Uma Wanume. He says, Ronald, I can't access the poll. Kindly guide. I hope Paul is probably not the only person who couldn't access the poll. Uma is not the only person who couldn't access the poll. The poll always pops up on your screen as soon as it's ready. You'll be able to see the poll on your screen. Please, Uma, don't mind, don't worry. The poll is going to come again on your screen. We want to hear your thoughts. Jemima Semakadegen says, okay, thanks. Probably Jemima is reacting to the fact that a copy of, they've already won a copy of poll of Moses Mukisa's Straightforward Financial Growth. Wilbur Birungi, finish the sharing on the treasury bills and then go to the questions. Probably Wilbur is so much interested in learning about the treasury bills. So, but Paul has been responding to this, except that There's a network breakdown. Probably we'll be getting back to Paul soon. Okay. Goretti Masade has shared the Twitter handle, and you can see it down below in chat. Twitter handle is at UIBFS Training and at UIBFS UG. Those are the two Twitter handles, but you could also still use yourmoneyken.that. I've been informed our poll is now ready. Please check your screens, look out for the poll. It's already running on your screens. I can see it on mine. And please feel free to fill in as many options as you feel available to you. And once you are done filling in the poll, you could just press submit and we'll be able to receive it over this side. I hope Umawanume, you are able now to see the poll on your screen. Okay. Enoch Okwara Edwaru, I have planted 4 acres of pine. The first 400 trees were in 2014 when I just joined employment. Much congratulations, Enoch Okwara in agroforestry. I think this is one example that we could probably learn from. Very good lesson here, Enoch. I wish everyone could share their experiences about investment. Like we've said, we are discussing contemporary, traditional versus contemporary means of investment. This is a topic that many of us actually don't seem to be very familiar with, because we talk about investments, like Paul just noted, many of us work within financial institutions, but still you'll be surprised that a great number are not even informed about the various investment options. One of them, from the traditional perspective, like Paul has been explaining, we've been talking about stocks. We've been talking about treasury bills and everything else. But when it comes to the contemporary or the new forms of investment, there are quite a number. Mutual funds, investment in art, and so many other things. What do you think, or what's your experience with contemporary forms of investment from the audience? Because remember, in the introduction, Paul said, and he said, he could be able to talk about investment. He's an expert, he's a professional. But then again, whatever he's going to share with us is not exhaustive of what happens within the investment world. What's your experience? Share with us. This could be someone who has had exposure with new forms of investment options, or someone who's already been running with the traditional forms of investment. Please, what is your take? What's your thought? What's your experience? Because I know investment is tedious. Many of us haven't ventured there, but at least some of us on call have done something when it comes to investment. It could be traditional, it could be a new form or contemporary. Let me see what people are saying here. Emesu Charles says that, Ronald, you haven't indicated whether this will be shared on YouTube, on YouTube channel, if any. Yes, Emesu Charles, we are going to share, we've got a YouTube channel. We'll be sharing with you the link to the YouTube channel shortly. We also have a portal, a web portal, where we publish all information regarding our webinars. You could go in, you can have a review of the previous webinars that have gone, the ones that you are not able to attend. Plus, you could also log in at any future time after these webinars have run. It could be next year, or it could be any other time in the future. These resources are kept online on our web portal, which is www.yourmoneyken.or.ug. Just browse that in your Google browser and you'll be able to access all the information which has gone before. Okay. The results of the poll have come through, and I would love to share with the rest of us. Now, the first question is, what form of investment do you own? 27% of respondents said they own rentals. 52%, and that's the majority, they said they own land as a form of investment. Others have invested in agriculture, that is 33%. Treasury bills, 6% only of the respondents. Then we've got equity, stocks, that is 12%. Fixed deposit accounts, 12%. Unity trusts, 18%. Insurance savings plan, 33%. Then business also standing at 52%. So you can see from the responses that many of us are still inclined to the traditional forms of investment, but it's our hope here that from this webinar going forward, people will pick up interest in the contemporary forms of investment and also gain interest or even the motivation to seek out counsel and professional advice regarding how to proceed with new forms of investment. The question number 2 was, what alternative forms of investment do you know about? 67% said they know about mutual funds. Others, 3% said they know about art as a form of investment, and 33% said they know nothing about alternative forms of investment. Where do you seek advice about investment? 76%, which is the majority, said they seek advice from friends. What's not clear is whether these friends are professional or just ordinary friends like me and any other Jew around, but it's okay. We seek advice about investment from friends. 55% said they seek advice from professionals, and 3% said they do not seek any kind of investment. If money is available, I just get my money and invest it in a piece of land or plot or whatever that kind of thing is. Now, we've seen that also a great number of people say they seek advice from professionals. Please write for us or engage with us on chat. Let's share as an audience or as a team. Thank you, Paul, you're back on call. Sorry for the inconvenience. We know the weather is not right and there are a number of challenges around connectivity. You are welcome back, Paul. We've just concluded a poll and the results have already been broadcast. We've had quite a number of engagements from the public, and the one which stood out for me here is as a new form really of alternative investment, although many people may not appreciate that, but agroforestry is one area which many people are starting to venture in. And one of the respondents, Enoch Okwara, said that he has invested in 4 acres of pine. The first 400 trees were planted in 2014, and that's when Paul had just joined employment. Okay, now, Paul, while you are away, a few questions came in. Do you want to respond to these questions, or we could probably get some insight? Because the poll that we just ran, 33% of respondents said that they tend to seek professional counsel from professionals. Many people, including myself, are not informed about these professionals. Are there any professional organizations that are specifically within the line of advising people about investment and financial wellness that you could mention about? Please, Paul. Paul? Okay, while we still wait for Paul to connect again, please, for the 33% of the respondents on call, please, let's know, share with us on chat, who are these professionals that you seek advice from? Who are the professionals you go to for advice when it comes to investment? Can I have someone say something here on chat? Let's get the conversation going. Paul already encouraged us to think like this is something that we all have ownership to. He's an expert, but he didn't come in to exhaust everything. You have indicated you consult with professionals. Who are these professionals? Barbara Namtesa says, I think, Barbara, are you asking a question? Why save for professional advice? I mean, just be a little bit more clear on this. Why save for professional advice? Are you asking a question, or you are saying that we have why save as professionals who advise people on financial matters and investment. Barbara? Okay, if Barbara is not responding, can I see Angela Namugaya says Zeno Investments and some American financial gurus online. Angela, do you want to share with us the exact websites where you, get to consult with these people, and how much do they charge for their services? Is it a free service or there's a fee attached to this? And how do we pay? Is it only Angela who represented the 33% out of the people who participated in the poll? Or do we just take Zeno Investments as the only professional people or professional team who advise us on investment? Okay. Now, I also received a number of concerns to say they would love to see the slides that were shared by Paul. They would love to get the Excel sheets. Others say they would love to get the videos. Now, let's also, the videos, like I already said, they'll be available, they'll be uploaded. One, you could see the videos on our YouTube channel, but there are also videos available on our web portal, which I've always repeatedly hinted about, www.humanken.or.ug. Please don't hesitate to reach out. You can make the downloads and enjoy yourself with the videos. Meg Bass says Bank of Africa custody is one of the professionals who can give you that kind of advice when it comes to investment. Angela Namugaya also says, I only follow their YouTube channels, Dave Ramsey and Gary Case. Dave Ramsey and Gary Case. You could probably go to your YouTube. You could go to YouTube and check out Gary Ramsey and Dave Ramsey and Gary Case for any kind of investment when it comes to, for any advice when it comes to investments. Now, dear participants, in the interest of time, because we only have about 4 minutes to the end of our webinar, I want to thank so much Paul for the time that he has committed to share with us his experience and expertise in the line of investment and contrasting traditional investments versus contemporary means of investment. At least I know we've learned a couple of questions, and 5 people have won themselves a copy. I already called out the names, and you could reach out by the same email address which you used for the invitation. Just write in, tell me where this book would be, or you could tell me how you want to access the book. You could probably walk into our office at Plot 10 Buganda Road, or if you're up country, you could advise on how this book can reach you. We can always find a means. We want to thank you so much for the time that you have committed to our call. We want to thank so much our strategic partners, Bank of Uganda, FSDU Uganda, and Summit Consulting. In that very regard, we thank so much our platinum sponsors, which is Bank of Africa. I want to encourage you again to tune in tomorrow and also for throughout next week, where we are going to be discussing insurance. Namirembe, you raised something about insurance. Your questions are going to be answered next week. Tomorrow's webinar is going to be about credit facilities, their terms and conditions. And we are going to have 2 speakers, Paul Nwagaba, the head of credit at Housing Finance Bank. We're also going to have Sarah Mirembe Namuyomba, who is the head of credit at KCB Bank. You'll all be really most welcome. Very soon you are going to receive invitations for tomorrow's webinar, informing you about the time and any other details. We appreciate the time you've spent with us. We want to see you more, but most importantly, we encourage you to take the initiative to seek financial wellness. This is just the beginning, but the real task lies on your side to make sure that we get that positive behavior change that we deserve. Thank you very much. We see you again tomorrow.
Your money can enable you to live a better life only when you budget and save before you spend. Act now. Learn how to manage your income and expenditure correctly at the Banking Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS.